Welcome. Thank you for joining us today, and welcome to the SGR's live webinar on the topic entitled Understanding the New Tax Rules That Will Change Every LLC and Partnership. Today's webinar will approximately be 1 hour. If you would like a copy of the PDF of this webinar, please let us know. Today's presenters will be SGR's Joe Mandarino and AJ Rowlands. Joe Mandarino is a partner in the tax practice in the Atlanta office of Smith, Gambrell, and Russell. Mr. Mandarino's practices focus on tax and finance. He is well-versed in a variety of businesses and transactions. AJ Rowlands is in counsel in the tax practice in the Atlanta office of Smith, Gambrell, and Russell. Mr. Rowlands is a tax attorney who focuses on representing individuals and businesses in their day-to-day operations in tax planning and tax controversies. Now I'd like to turn it over to AJ Rowlands to begin the presentation.
Executive Joe Mandarino, and we're going to cover a lot of things. We did a program like this more than a year ago. But there's been 4 significant sets of regulations that have come out. So we're going to update and try to answer all the questions that were unanswered at that time. We've still got some questions that the regs haven't answered, and the regs are in proposed format. So, you know, hopefully to the extent that they're bad regs, maybe they'll get fixed. AJ is going to kick off by doing some background about how the old audit rules and how they applied, and then we're going to sort of ping pong back and forth. I'm going to talk about some of the new rules, and we're going to go back to AJ and back and forth. So with that, AJ, why don't you tell us about what the lay of the land was before this new law?
Sure. Thanks, Joe. What's kind of strange about these new rules, and as we work through this hour, we'll touch upon that, is we have to go back to not just what we had before which is the TEFRA rules, but even what existed before then, because we've kind of gone full circle and for some taxpayers as we go forward. Going all the way back to 1982 is when the Tax Equity and Fiscal Responsibility Act, TEFRA, was created. It was generally a set of rules for partnerships that would provide how partnerships are audited. The reason TEFRA came into existence is that prior to TEFRA, the IRS didn't really have an easy way to audit a partnership. If the IRS wanted to audit a partnership, it would identify the partnership and then have to go and audit each individual partner. As you can imagine, it's kind of crazy if a partnership has 100 partners that you're going to have to go in and do 50 individual or 100 different individual audits, depending on how many they do. And as you can probably guess, this led to a lot of inconsistencies. Audits and appeals could be in different locations for different partners. You could get different results, different statute of limitations. Some partners would be treated differently than others. And it was quite an unequitable result if the IRS actually even was able to do all these audits. And beyond that, a lot of them they just ignored or didn't do because of the size and the scope. It was daunting and somewhat impossible. So what TEFRA did, it allowed the IRS to audit a partnership directly. That was a major change at that point in time. So each partner was required to treat the partnership items that were audited consistently. If the IRS was successful when auditing a partnership under the TEFRA regime, the partnership would file amended returns, and each partner would then report the change consistently. By way of example of a TEFRA audit, let's just take a NewCo, which we talk about in our example here. It's an LLC taxed as a partnership. It's formed in 2015 with 50 partners. And that year, NewCo reports a $5 million depreciation deduction that it allocates to its partners. 2016, the IRS audits NewCo and determines that the depreciation related to this power facility was not actually, the power facility wasn't actually placed in service until 2016. So the 2015 depreciation was incorrect. NewCo appeals this, goes through various determinations with the IRS, but by 2017, they agree to the adjustment. Under the TEFRA rules, NewCo is, I hope that screen is popping in a little better than mine. Under the TEFRA rules, the The NewCo would issue K-1s to each of the partners that would reverse the depreciation deduction, and for 2015, and then 2016 they would get updated K-1s for that year as well. Per the TEFRA rules, each partner was required to take a consistent position with those amended K-1s unless they if they did otherwise, they had to disclose it and they would be individually audited in that circumstance. The IRS didn't have to do 50 separate audits under TEFRA to get that result. We've attached a slide here if you want to look at it later. It's the GAO's summary of the TEFRA audit rules addressing various rules you'll see in the It's useful and helpful, but as TEFRA is going away, we're not going to spend a lot of time on it. The TEFRA rules, however, were complicated, and one of the biggest issues that started to arise under TEFRA was what was a partnership and what was a partner item. A lot of, well, I shouldn't say unnecessary, but a lot of litigation over that issue arose and began to bog down TEFRA as fights over whether things should be covered in TEFRA or outside of it. The TEFRA also created the concept of the tax matters partner, which anybody who's seen an LLC agreement or partnership agreement in the last 30 years, I'm sure has seen. The tax matters partner was the person who the IRS would look to during the audit to authorize actions on behalf of the taxpayer. TEFRA left very little protection for partners if the tax matters partner didn't notify them or tell them what was going on. And it was also difficult for the IRS because they had to communicate with the TMP, and sometimes the TMP was not responsive. Other practical problems the IRS faced with TEFRA was the simple inability to take the taxes that were assessed in disputes with partnerships and then actually collect them by assessing them against the partners. It's not uncommon to have these issues just simply disappear into the IRS system. So the IRS wasn't collecting money even after spending significant time litigating a TEFRA issue. And if a lot of the adjustments were small, the IRS wouldn't pursue the collection side of it with as much veracity as they probably should. IRS auditors became scared away of the TEFRA rules, and what we've seen over the last 10 to 15 years is an extremely low audit rate for high asset value partnerships as compared to corporations with similar amounts of assets. So something needed to be done, and with that, I'm going to kick it back to Joe.
Great. So those are the old rules, and there were problems with that. And then, so we're going to talk about the new rules, and AJ and I will kind of ping-pong back and forth. Let me try to get this. Okay. So this was enacted in 2015, but it is effective for years being audited after 2017. So realistically, it's not going to really apply this year because the IRS typically doesn't audit a partnership year until after it's over. But as you'll see, there's some language that you need to start thinking about putting in your partnership agreement, certainly for new partnership agreements, but even for existing ones, and we're going to get to that. You can also electively make it apply to earlier years, and there'll be some very rare circumstances where that will apply. It was done as a revenue raiser, right? And so CBO scored this at 9.3 billion. So unless somebody finds 9.3 billion, it's unlikely that they'll do away with this. So this is kind of for good, as it were. The IRS refers to these. The way they enacted it was actually to repeal the TEFRA rules, right? And we're going to get to the significance of that later if you are able to elect out of these rules altogether. And then finally, some people refer to these as the BBA rules because they're part of the Bipartisan Budget Act. The IRS refers to it as the Centralized Partnership Audit Regime, or CPAR. So we've got TEFRA, and now we got CPAR.
Okay. And we're sticking with CPAR. We like that.
Yeah, it's just 2 syllables. Okay, so like TEFRA, then CPAR is going to allow the IRS to audit and litigate partnership items at the partnership level. So there's still a debate. There will be a continuing debate over whether something is a partnership item. So again, you can look at that and say, well, you didn't really resolve that issue, and that was a flaw with TEFRA. That issue is still there. Unlike TEFRA, though, when an adjustment is made, it's going to be asserted against the partnership itself at the highest applicable tax rate. Now, this is a huge change in tax law. Everybody on this line knows one of the advantages of an entity taxed as a partnership is that it is taxed to the partners. The entity does not itself pay a tax. So this is a significant change. And it is so significant that you're going to see repercussions going throughout the partnership tax world, because it's going to affect agreements, it's going to affect how lenders think about partnerships, and certainly when you acquire partnerships, in the old days, we never really had to worry about income taxes because you as a buyer would never be liable for pre-closing taxes because they would get piped directly to the old owners. Because of this change, which is meant to facilitate the IRS to collect adjustments, because they can go after the partnership itself, it's going to mean that you have to do tax diligence the same way you did, environmental and consumer law and all the other types of things that you would look at. Okay. There have been 4 significant sets of proposed regulations that have been issued in the last year. There's one in the summer, that was the major one. It was 277 pages. In November, they issued a package on some of the international partnership tax aspects. In December, they issued rules addressing the push-out election, and in January, they issued rules for electing out of CPAR entirely, which you can sometimes do. So we're going to sort of follow this in this order, but we're going to start with some of the basics. So in the old rules, you had a TMP, right, a tax matters partner. Under the new rules, you have something called a partnership representative, or I call it the PREP because that's just one syllable. And that person has the sole authority to act on behalf of the partnership in any IRS audit. And unlike the TMP rules, the PREP does not have to be a partner or member of the partnership, so it can be an accountant or a lawyer of the partnership. It does have to have a substantial presence in the U.S., so the IRS has to be able to find this person, so you probably can't have a foreign entity or foreign individual unless that person also has a residence in the U.S. So first thing, if the partnership fails to designate a PREP, the IRS can designate any person to act as the PREP. And the fear would be if the IRS has trouble finding a PREP, it shows up at let's say it's got the tax preparer's information on the return, it shows up there and it tells the receptionist that he or she is the PREP. That's unlikely to happen, but we don't want to give the IRS that opportunity. So this is a key area that you do not want to neglect. You've got probably until the end of the year to figure this out, but you want to designate a PREP. You can do this in your partnership agreement. You can do it by resolution. Some agreements have sort of a strong GP, strong manager flavor, and the authority delegated there may be enough that you don't even need the owners to consent. You may need the GP. It may be enough for the GP or manager to pick a PREP. Even if it's not quite clear, you may want to do this just on a temporary basis until you have some other matters coming up for partner approval, and then you can get formal authorization. Okay. There is a consistency rule. So after the final resolution of an audit, all partners are bound by that determination. Partners, unlike under TEFRA, do not have the right to participate in a proceeding or receive notice of the same. So this simplifies the IRS's job, right? They just have to deal with the PREP. Now, if the partners don't like the resolution, they can file a notice of inconsistent position, which virtually guarantees an audit of that partner. But you can't just disagree and file your tax return. You either have to file it consistent with the IRS adjustment, or you have to file a notice of inconsistent position. Although, as we will find out, because there's an entity level tax, the partners may not even have to file a new tax return. Let's talk about some of the terminology. So under these rules, the reviewed year is the year under audit. The adjustment year is the year in which the adjustment for the reviewed year occurs. So let's say they're auditing the 2019 tax year in 2021, and they come to a resolution in 2021. 2019 is the reviewed year, 2021 is the adjustment year. and an adjustment can happen by settlement. So the partnership and the IRS agree on something. They can go to tax court, and you can have a tax court decision. That can be the adjustment. And then there's a procedure where it's a little bit like an amended return, but it's different, where the partnership can request an administrative adjustment. And that may happen, for example, because of a change in interpretation of rules or whatever, and the partnership wants to change how it's treated things in the past. So instead of filing an amended return, it files an administrative adjustment, and then you have, if the IRS accepts that, you have an adjustment year. Okay, so how do we do settlement and payment? Any adjustment is assessed in the adjustment year, not in the reviewed year. So there's a similar example. They audit NewCo in 2020 for its 2018 tax year. In 2021, they finally get around to proposing a change. NewCo concedes. So the tax liability is assessed in the adjustment year in 2021, even though the reviewed year is 2018. And the tax liability, the imputed underpayment amount, if nothing else applies, it is assessed against the partnership and not the partners. Okay. The imputed underpayment amount, that's a key number here, and we're going to sort of get into that at length. That is the net non-favorable adjustment to the partnership tax year, multiplied by the highest applicable tax rates under Section 1 or 11 of the code. So again, for the first time, a partnership, income taxes arising from a partnership are assessed at the entity level and not the partner level. And this has some other complications. So for example, penalties are determined at the partnership level. If you do a push-out election, and we're going to get to that, you can bring back partner-level defenses to penalties. The partnership rather than the partner statute of limitations controls. For example, there's a 6-year, a longer statute of limitation for substantial understatements. And substantial understatements, we measure the amount of the adjustment compared to your income. In the old days, you would do that at the partner level, right? So you may have a very tiny adjustment because that partner doesn't have a significant share of the income compared to that partner's other income. The 6-year statute might not occur or might not apply. Where you have, let's say, a financial partnership that has on gross, a rather substantial understatement, that could easily trigger the 6-year statute at the partnership, at the partnership level, not the partner. Okay. Now, there's the statute provides, even though we use ostensibly the first cut is at the highest tax rate, but there are some adjustments that can be taken into account when you calculate the imputed underpayment amount. So if any portion of a reallocation, let's say the adjustment is to reallocate some income from a regular taxpayer to a tax-exempt entity, if that tax-exempt entity, if the income was such that the tax-exempt entity wouldn't pay tax on that, you factor that into the actual adjustment of the tax. If ordinary income amounts are allocable to a C corporation has a lower tax rate, highest tax rate than a individual. If there are capital gains or qualified dividends that are allocated to individuals, that again is a lower tax rate than the top ordinary income rate. And if there are reallocations from one partner to another that results in decreases of income or gain or a decrease in deductions or loss in credits, all those are supposed to be rolled in. We'll do an example of that. One of the things that the regs, I think, finally cleared up is the statute had an ambiguity, because even though it required an entity level tax, it did not explicitly appear to relieve the partners of their general obligation to pay taxes on behalf of the partnership. So there's a concern that there would be a number of tax payments here that would apply automatically. So the partnership would have to pay at the partnership level. The partners then, under customary law, would have to file amended returns and pay the taxes themselves, and then somehow the partnership would get a credit for that. Well, the proposed regulations clarify the matter. that unless the partnership can actually elect out of the CPAR rules, and we'll talk about that in a little bit, or it makes the push-out election, which we're going to talk about, that the partners of a partnership will not be liable for adjustments arising from audits automatically, right? So the automatic, you don't do anything else, the partnership will pay the tax, and none of the partners will ever have to file amended returns or pay the tax. Now, having said that, if there is a procedure where the partnership pays tax, and then the partners can then file amended returns, and the partnership will get credit for the taxes paid by them and actually get some kind of refund from the government. It's not very explicit. They're still seeking comments on this, but in almost any instance, because the partnership uses the highest tax rates, that refund will not be complete. They may get 90 or 80% of their tax back, but they're probably not going to get 100%. Now, so it's clear you don't have to, but your agreement, for example, and this is why agreements are going to matter a lot more than they used to on the tax side. Your agreement could say, if there's an audit adjustment at the partnership level, all the partners are going to have to file their, even predecessor partners or prior partners are going to have to file amended returns and pay the tax that's appropriate. So your agreement could require that, but the IRS can't require it. Okay. And with this, I'm going to kick off, or going to kick back to AJ, and we're going to go through an example of how these new regs have bizarrely calculated this imputed underpayment amount in sort of an extended example. AJ?
Thanks, Joe. This is unfortunately where the sausage gets made in these new in the new rules, and a lot of what there was potential for this to go multiple different ways, but as the IRS proposed in the regs from this summer, it is very much a pro-IRS interpretation. And what we're looking at here are some examples of how the imputed underpayment is calculated. And before getting into the example, there are effectively three categories that have been created for determining if there's an imputed underpayment. Reallocation, which is basically determination of a credit, if an income or expense item should be allocated to one partner versus the other. That should make enough sense. Credit items, which are usually tax credit items, and then residual, which is pretty much everything else. And we're going to look at an example in the residual category here and see how it ends up affecting this taxpayer. This is pulled, simplified down from one of the examples in the regulations. It's in the slide deck if you want to walk through it, and you can probably find the specific one in the regs if you wanted to dig into that detail. But in our example here, partnership reports on its 2019 partnership return ordinary income of $300, long-term capital gain of $125, long-term capital loss of $75, and a depreciation deduction of $100. The IRS comes in and determines that their ordinary income should be $500, so that's a $200 adjustment. Long-term capital gain should be $200, that's a $75 adjustment. Long-term capital loss should be $25, that's a $50 adjustment. And the depreciation deduction should be $70, so a $30 adjustment. These adjustments are all part of what we just referenced, the residual subgrouping. The adjustments to ordinary income and the depreciation deduction are also part of the subgroup of ordinary income and residual. They'll get applied to each other because they're both within the same subgroup. But we're going to have different restrictions when looking at short and long term. Continuing our example, the decrease in the depreciation deductions treated as an increase in income of $30, thus the $200 adjustment to ordinary income plus $30 depreciation adjustment treated as increased income yields $230 of additional income in the ordinary subgrouping within the residual grouping. For similar reasons, the adjustments to long-term capital gain and long-term capital loss are grouped together in a long-term capital subgrouping within the residual grouping, and they're netted with each other. So for purposes of netting in the subgroups, the decrease in capital loss is treated as an increase in income of $50. The $75 long-term capital gain adjustment plus the $50 long-term capital loss adjustment yield $125 of additional income in the long-term capital subgrouping within the residual group. With respect to ordinary, the $230 adjustment to ordinary is a net positive adjustment for that subgrouping, and it's added to the $125 of income in the long-term capital subgrouping for a total netted partnership adjustment of $355. That's the total netted partnership adjustment. Then we multiply it times 40%. In our hypothetical, the highest rate in effect that's not set forth in the regulations. We look at whatever the highest rate in sections 1 or 10 or 1 and 10 are, and which results in $142 of additional tax. Points to consider in this. Each imputed underpayment is calculated solely with respect to that year. So if we are going to end up with an imputed underpayment amount, which is a net positive adjustment, we're going to look just at each year. Or within the three groups, reallocation, credit, and residual. Within the residual grouping, items are grouped by character and holding period, but we don't net these groups. The problem this creates is that only positive adjustments are used in determining if there's an imputed underpayment, and by positive adjustments, it means in favor of the IRS. So a imputed underpayment amount could be positive within the residual group, which it was in our example we just worked through, and then not but with a benefit to the taxpayer in the credit subgroup, but we don't net them out against each other. We end up with just an imputed underpayment for the non-favorable adjustment in the partnership tax year multiplied by the highest rate available in the code sections 1 or 11. The next example we have is how, which gets to one of the other items Joe mentioned, is how you modify the imputed underpayment amount based upon who the ultimate taxpayers are. So we'll go back to our example. IRS initiates administrative proceeding with respect to partnership's 2019 tax year. And this partnership has two equal partners during 2019. One is an individual and the other is a partnership partner, B. So A and B. For 2019, B, the partnership partner, the partner that is a partnership has two equal partners itself, a tax-exempt entity, C, and an individual, D. So we get to the point where the IRS mails a NOPA to the partnership for its 2019 taxable year showing a single adjustment. So we've got an imputed underpayment. We're going to, hypothetically, it's in the residual group, and the ordinary income is increased by $100, resulting in a $40 imputed underpayment. That's the $100 netted partnership adjustment multiplied by 40%. But as we mentioned, this partnership has an upper tier partnership, which one of its partners is a tax-exempt entity. Partnership requests modification under a certain paragraph within the regs, which it's allowed to because its partner B has a partner in it, which is a tax-exempt. The partner's partnership representative, the PREP, provides the IRS with some documentation, and we're not quite sure how this process is done yet, that C, the upper tier partner, is a tax-exempt entity not subject to tax with respect to its share of the partnership adjustment. The IRS approves this modification, and the $25 increase in ordinary income that would have been out of our 100 that would have been allocated to C is not included in the calculation of the total netted partnership adjustment. So the partnership's total netted adjustment is now reduced to 75. It would have been 100, but now it's 75 because C's share, its 25, has been taken out. And the imputed underpayment, which is reduced to $30, which is the netted partnership adjustment of $75, again, multiplied by our highest rate for our taxpayers here. Those rates are going to be changing, obviously, because of the new tax laws in effect, but we're just using the 40% because it's easy to calculate, and that's what the example is used. Some points to consider. Adjustments for amended returns filed by the reviewed year partner. That's what Joe was mentioning, that if there are amendments that have been done by partners prior to the payment, those are supposed to get taken into account. But as Joe mentioned, the rate that's applied to the partnership is probably going to be higher than what the individual taxpayers are paying because it doesn't take into account things like net operating loss carryforwards or other items that may be on the individual's return that could effectively pay off some of that tax liability. We do get adjustments for tax-exempt partners, as was seen in the example. There's adjustments for C corporation partners. Those are going to be greater than they have been before because the new C corp rate is significantly lower. Other modifications are on a case-by-case basis as approved by the IRS. This is, again, not quite clear how that's going to happen, and if there is going to be some flexibility, hopefully in the future, for addressing specific tax attributes that some of the individual partners may have. With that, I'm going to kick it back over to Joe to get into who is covered by these new rules.
Yeah, and just before we hit that, though, I want to kind of stress, so it was a big surprise when these rules came out, sort of how anti-taxpayer they were. The way the calculations work, it's sort of destined to increase revenue, and it really was just supposed to make collection easier. So like a typical example, you know, that we've kind of alluded to is like what we call a timing example, where let's say you take a bunch of depreciation in 2020, it turns out you shouldn't have started taking depreciation until 2021. So in a normal TEFRA audit, they would say, well, you actually get more depreciation than you counted on in 2021 and less than you counted on in 2020. We're going to net those adjustments, and oftentimes what happens is it just becomes an interest rate play. So you just have to pay, you know, a year's worth of interest for taking your deduction earlier. Under these rules, and it's sort of insane because they would say, well, the increase or the loss of a deduction in 2020, that is a net positive adjustment. So we're going to calculate that all the way into the adjustment year. The depreciation you should have taken in 2021 under this logic, we're actually not going to let you take it in 2021. We're going to pretend it happens in the adjustment year. So it's a sort of magical unicorn. And the, you know, I know most of this audience is lawyers, and this will largely be vexing, but the takeaway is that simple problems that came up in audits before were resolved usually with interest rate or interest payments and so on. Now there is a very high premium for agents to fly spec even small adjustments that mushroom into large adjustments because there's no netting in past years. So what you get is
no netting between. There's no netting between years, and there's no netting between categories. So you could have something that looks like a zero adjustment to a return because you got a credit that you otherwise improperly didn't have in that year, but they've adjusted ordinary income, and they only, for the imputed underpayment calculation, look at the adjustments that are in their favor. And then, as Joe pointed out, you have to wait for the magic unicorn to come back in the later years, which don't offset each other. So even a zero change to a tax year and what the taxable income should be could still result in interest and other interest penalties or other taxes potentially due.
So bad news. So as a result, there's going to be a premium on either electing out, or we're going to address this right now, or doing what's called a push-out election, which we'll address next. So the first question is, you know, can you get out of these rules? Well, they only apply to certain partnerships. So if you meet this test, you can elect out of the CPAR rules, and typically that's done on your tax return, although we need a little more guidance on that. Now, interestingly, you know, we mentioned that when they incorporated these rules, they actually repealed the TEFRA rules. So they didn't. So if you elect out, it's not like you get thrown back to the TEFRA rules. You get thrown back to the Wild West. So in fact, if you can elect out, there is no entity level audit. Now, of course, the IRS is going to have to go after individual partners, and it can subpoena the partnership to get records. Usually partnerships don't put up much of a fight, but it is a much more cumbersome operation for the IRS. So, you know, some would call these the bad old days. I would just call them the Wild West. So there's a great result if you can elect out. So how can you elect out? Well, you have to have 100 or fewer partners, and typically the way you do this is you count up your K1s. So it's not unusual where you have a husband and wife investing that you for whatever reason you'll invest you'll issue two K1s. There are procedures to just count that as one. So particularly if your client is a partnership with let's say 95 K1s, you might want to do a little bit of pruning and see if you have some couples, if you can just issue a single K1. One other thing is that if one of your partners is an S corporation, then each shareholder is counted as a partner. So you kind of look through the S corporation and you count its owners, and you can have a lot of shareholders for an S corporation. So don't forget to count them. Okay, so even if you meet the 100 partner count, your partners have to meet certain requirements. So they have to be an individual, a C corporation, a foreign C corporation, an S corporation, or the estate of a deceased partner. So any other type of entity, like a trust, a limited partnership, an LLC, potentially a government, right? Any entity other than these listed ones disqualifies you from electing out. So even if you have, two partners, but they're, one of them is itself an LLC, then you're disqualified and you can't get out of these rules. This we call it the upper tier partnership limitation. So if you have an upper tier partnership, that disqualifies you. That is such a significant limitation that some clients have talked to us about the fact that they want to limit who can become a partner because they don't want to be under these rules, and they want to limit transfers so that disqualifying partners don't enter into the partnership. Okay, so you may see that out there. The other thing that came out, so the proposed regulations took a bizarre position, which is so normally if, it's not unusual if you invest through like a single member LLC. So you're an individual, you form a single member LLC out of an abundance of caution to invest in some real estate deal, and that's a disregarded entity. And we would say, really, you just ignore that LLC and you look at who owns it. If that's an individual, great. That's a qualifying partner. So as long as you don't go over 100, you should be fine. The regs on election out say no. That is even though for every other purpose of the income tax code, we treat that LLC, we ignore it and we look through it. We're actually going to look at it and treat it as a regarded entity. And that disqualifies you from electing out. So let's say there's NewCo, it's owned 50-50 by Adam and Eve. Adam, on his lawyer's advice, holds his partnership interest in an entity called Holdco, which is a single member LLC that is treated as disregarded. The mere existence of Holdco in the ownership structure, even though it is ignored for tax purposes otherwise, prevents NewCo from electing out. So so unless the IRS comes to its senses, and there's a great deal of resistance and criticism of this rule, you may have to reorganize if your goal is to elect out, particularly where you have closely held partnerships. So Adam, you'd have to look at the specific facts, but if Holdco could transfer out the interest in NewCo to Adam directly, that would be fine. That should satisfy the election rules. Conversely, and this just kind of makes life more cumbersome, Holdco could elect to be a C corporation or an S corporation. So you've got an extra tax return there for no apparent reason. The S corporation route is pretty easy because it still gives you the flow through, but now you got an extra tax return. That just makes life more expensive. So the key is, how important is it for your client to be able to elect out of CPAR? If it's very important, you're going to have to do this type of planning to sort of prune the number and type of partnerships that you have. So the next type of election, and I'm going to pass over to AJ here, is the push-out election. And we're going to see lots of these because this is mechanically, it's much easier to do this. You don't have all the limitations that you do on electing out. So AJ?
Thank you, Joe. And to echo what you're saying, the regulation affecting single member LLCs makes absolutely no sense, but we're stuck with it. So if you want to be able to do what has been called the push-out election, when something becomes final, the partnership gets 45 days to elect to push it out. And we're going to get into an example with some of the detail of how a push-out works. But effectively, the partnership's going to issue statements which probably are going to be like K-1s to each of the partners for the reviewed year, reflecting the changes in the FPAA. The push-out election, the reviewed year partner is not as simple as simply determining the tax liability in that reviewed year and paying it. So it would be, we have to look and see how does this affect the partner each of the interim years. So if we had an audit of the 2020 year and the push-out occurs in 2023, we need to look how it affected that partner's interest in the partnership and their taxable income for every year in between. And then that partner is going to have to pay the sum of all those liabilities, penalties, and interest in the year for the year in which the statement was issued. There's an additional kicker of 2% interest for the pleasure of being able to do the push-out. But in a lot of these calculations, it's probably going to be a lot better and potentially more equitable to follow the push-out rules. The push-out election doesn't save the partnership from paying any, every time I read this, I say that. The push-out election, the most important thing it does is it saves the partnership from paying the entity-level taxes, and it puts the burden of those taxes onto the reviewed year's reviewed year partners, which seems a lot fair because we're not putting it onto an entity and its current partners. We're looking at just the reviewed year's partner. The interest rate increase needs to be taken into account when doing the complicated calculations to figure out what's going to be paid. But again, probably going to lead towards recommending push-outs. Maybe more equitable to the partnership perspective. It has the right people paying it. We don't have to look at complicated tax indemnity provisions in operating agreements to try to enforce this if we paid it at the partnership level and to try to true up the true effect to each of the partners. We've got another one of these wonderful examples out of the regulations, and the push-out examples and regulations do make a little bit more sense from a fairness perspective than a lot of what we saw in the first reg package, which dealt with how you calculate the imputed underpayment. We got an example here where a partnership has two equal partners for the 2020 tax year, A, an individual, and B, a partnership. That's why we couldn't elect out. We had an upper tier partnership. B, the upper tier partnership, has two partners, C and D. So the IRS mails this partnership an FPAA for June 1, 2023, which increases its ordinary income by $500,000. It starts an imputed underpayment of $200,000. Again, that's just using the 40% rate in the hypotheticals. The partnership doesn't petition to tax court, and this adjustment becomes final. And the dates are not necessarily important, but for separating out what has to happen in what order they are. So on August 30, 2024, it becomes final. As we mentioned early on, there is a 45-day period in which to elect to make the push-out. The election itself is simple enough by it's notifying the IRS, but a calculation to the partners and the IRS of who owes what tax based upon that adjustment needs to be done within 60 days. So from August 30th, in our example, that takes us to October 29th. That's a 60-day period. You better hope it's not during busy season because these complicated calculations need to be done within that period or you are not going to be able to push it out. Those taxpayers who receive the push-out election have to make the payment before the due date of the return for the partnership from the adjustment year. So the 2023 partnership return would be due on March 15th, 2024. It could be extended to September 15th with the 6-month extension. So prior to that date, whichever one it is, the partners have to file and pay the taxes based upon that calculation. I went one slide too far. The statements are going to be issued to A and B, which would reflect an adjustment of $250,000 of ordinary income. A is an individual, so it's easy enough. The individual takes the adjustment into account on its 2023 Form 1040. It's going to have to be filed and paid by the due date that the by the of the partner, or has to be paid by the due date for the partnership. So that 1040 and the payments for it, we're going to need to get in before September 15th, at least for the payment, if that's the partnership due date for its return. It's more complicated for B, the upper tier partnership. It has a choice. It can simply elect to pay, because the CPAR rules have partnerships now paying taxes. So it could elect to pay the tax itself. And if it does that, it's going to be paying just like the individual, and it's going to pay it by the due date of the lower tier partnership's return for 2023. But if it elects to push out, it needs to get statements to B and C. B needs to get statements to C and D, its partners, and they need to be issued before the due date for B's Form 1065 for the adjustment year. So and now B needs to get these statements out before September 15th of 2024. That then pushes a burden to C and D, and and in the example in the regulations, C and D are individuals. They receive their statement for the due dates, and then they are going to have to either have paid them by that September 15th date if they got them earlier, or they're going to have to pay them within 30 days thereafter. What gets confusing and isn't in the regulations is what happens if C or D are themselves upper tier partnerships and they keep pushing out, because we start to have the dates start to pile on top of each other and calculations need to be done within the 60-day period and then 30 days to pay. The IRS contemplates this by saying once the statement's received, there's 30 days to pay, but with enough upper tier partnerships, the 60 days for calculation and 30 days to pay can kick this down the road quite a ways. Will be interesting to see if that gets addressed some more going forward. Joe, do you want to jump back in now and discuss some of the international aspects, or discuss that a little further?
Yeah, no, let me take back the remote control. Sorry, we have a, okay. So the IRS has issued some proposed regs covering, a number of international partnership tax issues. So one of the things they addressed was the fact that, by its terms, CPAR only applies to certain provisions of the code, the main income tax ones, but not withholding taxes. They are not covered by CPAR, but the IRS has indicated that, and this is true, that it can conduct a partnership level audit of withholding tax obligations under existing law. I don't think there's much controversy over that. And they have kind of noted the fact that, in a way, because withholding taxes are assessed against the entity, it is a very similar construct to the CPAR rules, because withholding taxes have always been assessed against entities, even though they are taxes that are collected from actual taxpayers. They also said that the issue of what your creditable foreign tax expenditures and your indirect foreign tax credit are when they're allocated through a partnership, those will be audited at the partnership level under CPAR. There's some resistance to that. Again, you get into this issue of what is a partnership item. The IRS has asked for guidance on how to take into account possible modifications to the imputed underpayment rate to reflect the status of non-U.S. partners and non-U.S. partners that may be able to use low tax rates under tax treaties. So that once you come up with your imputed underpayment amount, you've got some adjustments to make if you have tax exempt or corporate versus capital gains and all that stuff. So they want to think about, they want people to comment on how to take into account the fact that you may have some foreign partners who are paying even lower tax rates because of tax treaties. Now, they did clarify the following. If they conduct a withholding tax audit and then collect withholding tax from the partnership, they ignore that adjustment for any imputed underpayment under the CPAR rules, okay? But if it goes the other way around, if they conduct a CPAR audit and they collect an imputed underpayment amount from the partnership for an amount that would be subject to withholding, then they credit the partnership for the withholding tax obligation because it's paid it at the entity level. That, I think, could be challenged. I don't know that any taxpayer in the world would challenge that, but there is an argument that that's actually incorrect. But we will not tell the IRS that because they already have enough power. Let me try to make this slide move. make sure I've got control here. Sorry, this is a new, okay. So those are the nutshell of the rules. And now I think we're going to try to use the last 10 minutes to address, what do you do today? So for new agreements, they present the best opportunity to start thinking about these issues today. Some of the approaches that we've seen are sort of at a minimum put in language to address the appointment of a prep. Sort of a standard boilerplate that I use is that the LLC will, if it can, elect out of the new rules completely for each year possible. But, again, given the IRS position on this and the way the statute is written, if you got any upper tier partnership, you're not going to be able to get out of it. Also, provide that if the LLC cannot elect out of the new rules, it will make the push-out election. And, AJ has kind of intimated some of the advantages of the push-out election are that the way the assessment works, right? You tax the partnership rather than the partners, but also you tax the partnership in a different year, right? So if it's an audit of 2018 and it happens in 2021, those partners may be different. They won't be paying the tax, but they'll indirectly bear it. And many people, if you were an investor, particularly a new investor coming in, you would want some kind of indemnity that if that happened, that the prior year partners would indemnify you for it in some fashion. The benefit of the push-out election is it pipes the liability directly to those prior year partners. And as long as we are sure that they can make that election, and again, it's more of a negligence issue. I mean, any partnership can make the election. You just got to make sure you actually do it on time. If you make that election,
complete your calculation.
Yes, and as long as that happens, then you as a new investor can be assured that you will never get tagged with somebody else's tax liability. Even though there's a higher interest rate because of the new 20% pass-through deduction, you may be fine with that, right? You even if you're a prior year partner, you may end up, even with the interest, paying less than would be paid at the partnership level. So now the IRS may come and
the imputed underpayment language doesn't contemplate the new deduction in the new tax law. So there's a lot. There's, to Joe's point, even more reasons to look at pushing out, because you're not just going to be multiplying it by a flat rate in the code.
Right, and so you could even without the interest rate, it may make more sense to do. Even without the equity issue, it may make more sense to do the push out. So we're big fans of the push out. Now, having said that, some agreements that we look at in draft, they let the GP or manager, they give it broad authority to determine whether to make, first of all, the election out, and there are some this is a digression. There is a sort of burgeoning school of thought that, particularly in a flip partnership, it may make sense to do the to stay within CPAR and not make a push-out election. So depending on what if there's particularly a tax-driven need for this, you may not want to elect out and you may not want to push out. But more likely, what would be the case is, let's say you have a de minimis adjustment. If you make the push-out election, everybody has to amend their returns. They've got to call their accountants. It's a lot of money on compliance side. If you're talking about a $10,000 adjustment and you have 20 partners, it may make more sense for the partnership to pay the entity level tax and not push it out. So that would be the argument, for letting GPs and managers make that determination. We also see some agreements that are trying to restrict the types of partners members that can join in order to facilitate electing out of these rules. But as a business matter, that's very hard to push because, at first you say, yeah, I want to elect out, but then you find that some people will only invest through entities, particularly if a private equity group comes through, it's not going to, invest individually. So, sometimes you just got to get your money, and to get your money, you're going to have upper tier partners. So you're not going to be able to elect out. Luckily, the push-out election is so attractive that you can probably get the same result or a good result even if you can't elect out completely, if you can push out the liability.
And there's unlike the S corp rules, there's no way to cure if you had a inadvertent transfer to an entity or partner that makes the election out ineffective. So you can't go back and fix it if you had a single member LLC in there that you didn't realize was a member, or an entity changed its tax classification from corporation to partnership. You can't go back and undo it.
Yeah. So at a minimum, we're telling people you need to discuss, for new agreements, you need to kind of think these through with your client. Okay. So what if you have an existing partnership? What can they do? Well, that's a more difficult case because it's often hard to get consensus on how to address different issues that the new rules raise, and we're still uncertain, what are best practices at this point. So most of the existing partnerships that we've discussed the issue with are deferring action for now. They want to say a little more about how the regulations come out. Some of them just sort of are vaingloriously hoping that there'll be a repeal. I don't think that's in the cards because of the budget scoring rules. But let me go back. But even with an existing agreement, even if you don't want to amend it, you should at least appoint your partnership rep so that you don't get surprised because somebody's receptionist was appointed your partnership's representative. So another thing that people are doing, there's many unanswered questions, but most of them, there's many unanswered questions in the statutes, and most of them appear to be answered adversely in the proposed regulations, which is not good. One of the things people were hoping for was a delayed effective date. There's nothing like that being talked about. So so it looks like 2018 will be the first reviewed year that this will be effective for. There are very rare circumstances where you may want to apply it to years before 2018, and those are very tax-driven partnerships. The other thing that we're seeing a lot of is, to be honest, just the use of boilerplate. So as I said, sort of if you can't figure it out in a new agreement, decide to elect out, always have this sort of default rule that you're going to elect out, and if you can't elect out, make the push out election whenever possible. And I think particularly with the changes under the Tax Reform Act, the push out election looks very attractive. Maybe we'll see the IRS come to sense and at least address the 20% partnership deduction as a factor in the imputed push out. But there is a counter argument that the way the 20% partnership deduction rule applies, since it applies solely for a specific purpose, that you can't hopscotch it into these regs. So
and the election out has to be on the tax return, but the push out doesn't have to be decided until after there's a determination of an imputed underpayment. So there is some time to think about the push out, and for the parties to at least to agree to that. We're probably several years down the road from when somebody actually has to decide to make a push out, just because returns won't be filed. But we are going to start touching periods where these tax years are going to have to either elect out or not on the returns.
So unless there's some questions, I guess I would just sum up by saying this is a significant change, particularly on the deal side. When you acquire a partnership interest now, you've got to look at things like, whereas before you could rely on the way that taxes were piped and you never had to worry about pre-closing tax liabilities. Now you have to worry about that. So you'll want the partnership to either have a mandatory push-out election, or I'll give you as the new investor the right to force them to do a push-out election, which we've seen in some agreements. Secondly, if you're a lender, you never had to worry about the partnership having a tax liability, right? You might be worried about environmental, you might be worried about other contractual liabilities, but you never had to worry about taxes. So now what we're seeing is some lenders requiring partnerships to mandatorily make push-out elections under any circumstance, even a de minimis amount. And I think you'll see that increasingly, and it's not unreasonable for a lender to ask for that. It allows them to assess risk more carefully. AJ, did you have any concluding thoughts?
No, I think we've touched upon the key points of the regulations have not been very taxpayer-friendly interpretations, and there's going to be a lot of learning on the fly for taxpayers and agreement drafters.
So thanks for tuning in, and if you have any comments or suggestions for how to improve this program or other programs you'd like to see, we would really appreciate your feedback. And I think most of you are on the East Coast, so I will let you go to lunch now. Thanks so much.
Also, I just wanted to remind everyone, again, if you would like the PDF of this webinar, please email sgrcommunications@sgrlaw.com and we will send you one. And for more information on upcoming events and webinars, please contact us at sgrcommunications@sgrlaw.com or visit our website at sgrlaw.com. Thank you and have a great day.